Hello, I'm David Smith, Senior Investment Director, Asian Equities at abrdn. I'm also the Portfolio Manager for our Asian Sustainable Development Equity Strategy. At abrdn, we know that interest in sustainable investing has grown substantially over the last few years. The industry's approach to sustainable investing has broadened and deepened. The focus has moved from minimizing negative impact to maximizing positive impact, with clients increasingly asking how a focus on environmental, social, and governance factors, otherwise known as ESG, can help with returns. The question we're commonly asked as a firm now is, which are the right investment strategies and vehicles to achieve both portfolio returns and positive impact for the world we live in? At abrdn, we've created the Asian Sustainable Development Equity Strategy to meet that demand. This strategy allows you to make a real impact with your investments, but also offers capital appreciation potential via diversified thematic opportunities. For a bit of background, this strategy was designed to support the UN's Sustainable Development Goals, also known as UN SDGs. These are 17 goals set by the United Nations Development Programme. The UN Development Programme, which created these goals, states that the Sustainable Development Goals are the blueprint to achieve a better and more sustainable future for all. They address the global challenges we face, including poverty, inequality, climate change, environmental degradation, peace, and justice. Despite the urgency, progress is slow. Recent research from the UN suggests that Asia-Pacific region is well off target with regard to UN SDGs, with the UN estimating that it now may take until 2065 to achieve the 2030 targets. With every year, Asia appears further from achieving the SDGs. It was estimated in 2017 that Asia would achieve the SDGs by 2052. In 2019, that target had regressed to 2057, and by 2021, it was pushed back further to 2065, 35 years behind the original 2030 target. It means a child born in 2015, the year the UN released its goals, would be 50 years old before the SDGs were achieved, so potentially a parent or even a grandparent. That would be too late for them to benefit from original SDG targets on education, for example, and too late even for their children. The UN concludes that less than 10% of the measurable targets are on track to be achieved by 2030, and the remaining targets require urgent and rapid acceleration of progress or reversal of negative trends. To construct our strategy, we've distilled the 17 goals into 8 thematic pillars for investing: circular economy, sustainable energy, food and agriculture, water and sanitation, health and social care, financial inclusion, sustainable real estate and infrastructure, and education and employment. We've also included an allocation for what we call SDG leaders, companies whose technology, products, or services are integral to the supply chains of companies achieving the SDGs. We manage the strategy actively and combine bottom-up stock selection with proprietary SDG alignment analysis. It comprises 30 to 60 of our best ideas. Essentially, we see 3 key reasons to invest in this strategy. It delivers dual outcome, both capital appreciation potential and the chance to make a real impact. It offers diversification of economic exposure across a variety of development needs, such as decarbonization, access to healthcare and the financial system, and infrastructure. It is driven by tailwinds from rising capital allocation to SDGs and policy support for critical development areas. It bodes well for this strategy's upside potential. The Asian Sustainable Development Equity Strategy has a focus not only on returns, but also on making a difference. In terms of outcomes, the Asian Sustainable Development Equity Strategy has a 62% lower carbon footprint than the MSCI AC Asia Pacific ex-Japan Index. Currently, its main allocations are to companies helping to drive decarbonization via renewable energy, providing access to finance, including microfinance, and helping to develop sustainable real estate and infrastructure across Asia Pacific. We also actively engage company management teams to improve corporate performance and ESG reporting. At abrdn, we engage with companies for 2 reasons: to protect and enhance the value of our clients' capital, ensuring that management teams remain focused on strategic issues and that boards are diverse, renewed, and oversee management. Also, to focus attention on the UN's SDGs and disclose more on the impact they're having. Disclosure in Asia remains relatively less advanced. We believe that improving disclosure can only be helpful, particularly given growing interest in this area from investors. Based on track record so far, the Asian Sustainable Development Equity Strategy has proven successful. The track record shows a 13% outperformance versus the respective index since inception. The strategy has also shown an upside capture ratio of 99.58% and a downside capture ratio of 68.01%. This means that in challenging conditions, on average, the strategy will fall in value 30% less than the market average. Once market conditions improve, we capture almost all the upside growth potential. The second reason to invest in our Asian Sustainable Development Equity Strategy is diversification of economic exposures across a variety of development needs, including decarbonization, access to healthcare and the financial services, and helping to build out sustainable infrastructure in Asia. While there is significant interest in thematic strategies with a single theme, we believe in a diversified approach that provides a wider range of opportunities and arguably lowers risk. Furthermore, the strategy is diversified by geography across developed, emerging, and frontier markets. It's also diversified by market cap and invests in small, mid, and large cap firms. Presently, the Asian Sustainable Development Equity Strategy has the largest investments into the following 5 key pillars: sustainable energy, impact leaders, financial inclusion, sustainable real estate and infrastructure, and health and social care. As of February 2022, this translates into a focus on sectors such as information technology, financials, industrials, healthcare, real estate, and utilities. In turn, this translates into the largest exposures being to markets such as China, India, Taiwan, Hong Kong, Indonesia, and Australia. However, we adjust allocations regularly based on our proprietary research findings and continued analysis. The third reason to invest in the Asian Sustainable Development Equity Strategy is rising capital allocations to SDGs. Policy support for critical development areas bodes well for the focus of this strategy and should drive opportunities for investors. From 2015 to 2020, allocations to impact investing grew 20-fold, from $36 billion to $715 billion. Flows are taking off, and we're seeing more investment into impact investing. As for tailwinds accelerating change, we've observed the 4 Ds. Demand for decarbonization, for access to healthcare and financial services, for energy efficiency and infrastructure. Disruption, required to change the world and present investable opportunities. Digitalization, scaling up the ability to deliver social impact at a faster rate, including areas such as financial services and healthcare. And finally, direction, stronger, clearer policy support providing longer-term assurance and stability and encouraging a rapid rise in capital allocated to sustainability. It means tailwinds for investing in the UN's SDGs, presenting off investors with potential growth opportunities. There is much upside potential. Here are 4 key points of evidence from the UN SDGs highlighting the size of the opportunity. From now until 2050, there's an anticipated annual spend of US $5 trillion to support the path to net zero. That's double the existing spend today. We've observed a growth of 8 times in ESG-focused equity funds in the 6 years from 2015 to 2021, worth $1.6 trillion. We have seen certain sectors grow exponentially. Electric vehicles, for example, are forecast to see 1,800% growth in production volume from now until 2030. There were 1.7 billion unbanked adults worldwide in 2017, and half of those were sitting in Asia, pointing to a huge addressable market. All of these key points underline the great upside investment potential based on the UN SDGs. In summary, the Asian Sustainable Development Equity Strategy offers the dual outcomes of sustainable impact and portfolio performance. It also diversifies your economic exposure, while the push for progress provides tailwinds that translate into significant opportunities for investors. Importantly, investing in the strategy means partnering Aberdeen in sustainable investing. We have been present in Asia Pacific for more than 30 years and have invested in the region for longer than that. While investing sustainably is a new concept for many, it's been part of Aberdeen's DNA from the start. We developed our first sustainable strategy back in 1992. Since then, we've strengthened our analysis, deepened our investment expertise, and created a diverse range of solutions for clients across equities, fixed income, real estate, infrastructure, and private equity. To find out more about abrdn's Asian Sustainable Development Equity Strategy, contact us. We'd love to hear from you. Thank you.